If you open any financial website or newspaper, you'll inevitably come across titles like, "Does this bull market have longer to go?" Or, "The bear market is just around the corner." If you are new to investing, you're probably wondering, what are these strange animal references all about? The terms bull and bear are used to describe how the stock market is doing. A bull market is characterized by confidence in the economy and in the stock market. During this period, stocks are mostly going up. On the other hand, a bear market is marked by pessimistic and fearful sentiments, resulting in declining stock prices. In addition, bear markets are often, though not always, accompanied by economic recessions. In very simplified terms, bear markets are the bad times, and bull markets are the good times. It's important to point out that these periods are a mix between objective economic data and investors' psychology. In other words, if everyone expects a recession, a bear market may begin well in advance of the actual recession starting. Same with the bull market. Typically, it begins when the market sentiment turns positive, even if the economy itself is still in shambles. You may be asking, why are these two animals used in describing market sentiments and not others, like a lion and a zebra, for example? A zebra market sounds good, doesn't it? Well, the exact origins of using bulls and bears are unknown, but there are some credible theories. The most popular one cites the way the two animals attack. A bull thrusts its horns upward, symbolizing rising prices, while a bear swipes its paws downward, representing falling prices. Bull and bear markets are not just about sentiments. They have real numbers defining each. The arrival of the bull market is pronounced after the stock market gains 20% from its previous lows. Following the same logic, a bear market begins after stocks decline by 20% from their recent high. By the way, the terms bull and bear are not reserved just for the markets. You can say that you are bullish on a certain stock if you think that the price of this stock will rise. This terminology is also widely used by financial analysts when they are writing reports about companies they cover. For example, a certain economic event or trend may get classified as bullish or bearish for the company prospects. As you can see, these two animals have become truly omnipresent in finance. But let's get back to markets. Bullish and bearish periods are inherently cyclical, meaning that the end of one defines the beginning of the other. However, their average length varies significantly. Take a look at this graph. As you can see, bull markets last for much longer than bear markets. The average bull market run is around 5 to 6 years, with some spanning over a decade. On the contrary, bear markets last just over a year on average. As I'm writing this in November of 2025, we're in the fourth year of the current bull market for the S&P 500, which started in October 2022. And the most recent bear market occurred just before that, between January and October of 2022. Generally speaking, the stock market spends about 75% of the time in a bull cycle and only 25% in a bear cycle. Not only that, but it also gains a lot more during good times than it loses during bad times. Just look at how much taller those green mountains are as compared to the gray areas underneath. This supports the thesis that the market as a whole goes up over the long term, which allows compound interest to do its wonders and deliver good investment returns to you, the investor. If it was a 50-50 split, it would have been a much tougher game. Luckily, investing is not that difficult. You can learn it in under 5 minutes at a time. So keep learning with 5-Minute Investing. Hey, wait a second. This is the 4th video on this channel, but the first one that doesn't mention Warren Buffett a single time. Oh, well, not anymore, I guess.